See, let's say I take a business here. Let's say it is XYZ stores. Okay. Let's say it is XYZ stores. Since the name you can understand it's a sole trading firm. Okay. So XYZ stores have like transactions on daily basis. What do you mean by transaction? Transactions are nothing but such activities where exchange of money is involved. In the sense, if I sell, like if XYZ stores sell goods to customers, they will charge something for that. They'll collect money for that. Isn't it so? So money is coming, goods are going out. This is a kind of a financial transaction because this can bring some changes to the business. So activities which bring changes to the business are transactions. Okay. What changes it can bring? One thing is the inventory is going out and the inventory is decreasing, cash is increasing. Correct. So these transactions which happen on daily basis have to be what? Recorded. Okay. So where will you record? Will you record them in ledger directly? Please tell me. No. They cannot be recorded in ledger directly. Before recording those transactions or posting those transactions, I mean say posting. Okay. Before posting those transactions in ledger, they have to be recorded in the books of prime entry. What did I say? Books of prime entry. So what I'm saying, before posting the transactions in ledger, we have to record the transactions in books of prime entry. The books of prime entry here are nothing but there are some books of prime entry which I'll write it here and then you can make a note of it. The books of prime entry, I'll make a tabular form here. So before that, I will write some notes. Okay. So the notes are the ledger accounts of a business are the main source. See, it is the ledger from which you will prepare the trial balance and then the financial statements. You will not prepare the financial statements directly from journals or subsidiary books or books of prime entry, which I am going to explain you right now. For you to make a financial statement or financial report, the source is ledger. Okay. But we cannot directly post our transactions in ledger on daily basis because there is a chance that like every day it is not easy to update ledgers. Every day it is not easy to update ledgers. The ledgers are prepared at the end of the month. Okay. But even to make ledger accounts, you should have some basic basic books where you can record your transactions generally. See, ledgers are prepared at the end of the month or 15 days. Let's say it is not easy to update them on daily basis. Okay. So what I'm saying is, but to post the transactions in ledger or to give a journal a double entry form in ledger. Okay. To give transactions, sorry, not journal, to give transactions a double entry form in ledgers, first they have to be recorded in journals. Okay. And not only journals, there are some other books even where the transactions can be recorded. So I'll name them right now and I'll explain you what's the difference. Okay. So just a second. So ledger accounts of a business are the main source of, so you have been studying this since you're in like intermediate or your like senior secondary schooling and your graduation, but you don't know really why you make what's the importance of books of prime entry. Okay. The ledger accounts of a business are the main source of information you used to prepare the financial statements. Okay, so they are the main source of information for preparing the financial statements. However, if a business, hopefully everyone is following. Am I right? Everyone is following, correct?
Yes, sir.
Yeah. Yeah. However, if a business were to update their ledgers each time a transaction occurred, excuse me, So transaction occurred, the ledger accounts would quickly become cluttered. So the meaning of cluttered is unorganized. That means there'll be a lot of confusion related to that. Like it not be easy to record the transactions on daily basis in ledger, or it is not easy for you to update your ledger on daily basis. Okay. And errors might be made. Okay. So this would be very time consuming process as well. That is also a point here. So to avoid all these things, what we do, we record the transactions initially in books of prime entry. To avoid all these complications, we record all transactions where to avoid all these complications, record all transactions initially. So that's what I'm using the word initially for the first time in the books of prime entry. Okay. So it's very easy to understand, and like this is a simple note of transaction, the relevant customer, supplier, and the amount of transaction. Like it becomes easy for them to daily see what transactions they are having, and they put those transactions or record those transactions in the relevant books of prime entry. Now we will see what are the books of prime entry. Okay, we'll name them right now. So here is a tabular representation I'm doing. Books of prime entry, and then comes transaction type. Okay, so first books of prime, in the books of prime entry, the first one what I'm mentioning is sales day book. These are also called day books. Okay, because we record everything on daily basis in them. And here we record only credit sales, because this is the book specifically meant for recording what? Which kind of transactions? Credit sales transactions. Okay. So in sales book, we record credit sale transactions. Then comes the purchase day book. This is also called as a day book only. Why? Because we record the purchase transactions which happen in our business on daily basis in this book. But mind it, which kind of purchase transactions? Credit purchase transactions. Are you following? Please tell me.
Yes, sir.
Yeah. Then the next book comes sales returns day book. So it was very necessary for you to know, like when we are preparing journals and ledgers, why we prepare, what's the use of all these books. So I have explained you right now. The books of prime entry is nothing but the books which I'm mentioning. Along with that, journals is also a book of prime entry. So we record the transactions in the books of prime entry initially or for the first time. Then we post them in ledgers. And from ledgers we prepare trial balance, and through with trial balance, which is nothing but the source of preparation of financial statements. So returns of goods on credit. Then comes the purchase returns day book. Returns of goods sold on credit, here purchased on credit. So we'll see the details, Ivan, don't worry. Right now just I'm putting a tabular representation here. Then comes the cash book. So all cash transactions, or I would say bank transactions. Then comes the petty cash book. So all small cash transactions, very petty, like $5, $10, very small transactions. All small cash transactions. Then comes the journal. Now you will be asking me a question, sir. Why then, like what is the need of all these books when we can post the transactions in journal as well? See, these books are specific for those specific transactions, and those transactions which we record in these subsidiary books can also be seen in journals. But there are some transactions for which we do not have books. I will explain you that. Those transactions can only be recorded in journals. So I'll write a note here. What I would record in journals is all transactions. Are you following? Yeah. All transactions not recorded elsewhere. That means the transactions which I cannot record in all this above mentioned books of prime entry, I would record them in journals. So I'll put some example. First of all, are you making a note of this table? If you are making, then I'll be waiting. Please
Yes,
tell
sir.
yes. Yeah, okay. Go ahead. Tell me, I'll scroll down, okay?
Yes, sir. Could you scroll down a bit?
Yeah.
Yes, sir. Done.
Yeah. Who have you finished? Hello?
Yeah, sir, just a second.
Yeah, yeah. Once done, please tell.
Done, sir.
Yeah. So I'll write some point here regarding the journal. The journal. So it is a book of prime entry. In which the transactions which are not routine and not recorded in any other book of prime entry. Okay, for example, so all this like you make a note of this point. I'll write those like things down. Now don't be confused. See, purchase transactions we write in journals, and credit purchase or cash purchase, whatever we show in journals. But especially there are books also for that. So we record them in the books even. But there are certain transactions which do not have any books at all. So those transactions cannot be recorded elsewhere. They can only be recorded in journals. Okay, I'll show those transactions to you.
Done, sir.
Okay. So for example, I'm continuing from there. Here you can follow. So like all the year end adjustments. Like depreciation charge for year. So you don't have any separate books for this. Depreciation charge for the year. This now can directly be posted to ledgers, okay, from journals. Then irrecoverable bad debts, or I can say debts, that's enough. Irrecoverable is bad debt only. Debts return off. Then record the movement in allowance for receivables. Or let's say provisions even. So all these things are new maybe for you, but we will be dealing with them in details in the coming chapters. Then accruals and prepayments. Yesterday itself we have discussed the journals regarding accruals and prepayments. I've given 4 entries at the end. Hope you remember. Then closing inventory. Then any kind of acquisition and disposal of non-current assets or purchase and sale of non-current assets. Now you'll be asking me a question, sir, we have purchase book for that. No, purchase book is specifically for merchandise purchases. That means only the goods what you purchase for your business, the inventory what you purchase for your business from any supplier on credit basis would be recorded in purchase book. Okay, not any kind of non-current asset like land, building. No, those are not the inclusions in the purchase book. Those cannot be recorded. Acquisitions and disposals, that means sales. Disposal means sales. Disposals of non current assets. So you don't have separate books for all this. Okay, and like if I have to say opening balances for statement of financial positions, opening balances for statement of financial position items, and last correction of errors. So these are all recorded in journals. Please make a note of this. So already you know how to make journals. Like if you make some journals, yesterday I showed you, if you purchase, if you are buying some building, so non-current asset account, and that too you are buying on credit basis. Suppose I bought a land from my friend. So land has come to me. Increase in asset is debit, but I did not pay cash to him. So it is payable. So increase in liability, it is credit. So non-current asset to payables. This is the journal which I can write. Correct? Please tell me yes or no. Yes.
Yes, sir.
Yeah.
Done, sir.
Okay. So now, since all the things are very clear to you, now let's do one thing. Let's understand the format of each and every book. Correct? Let's do that. Yeah. Put the formats in front of you. After putting the formats, we can do questions regarding these books. Okay. So make a note of these formats. Simple formats like sales day book. So you have date. Okay, as like you'll be having dates every day in a like in a month. Jan 1st, let's say you are putting Jan 1st or you are putting Jan 2nd. Okay, so this is the one. And or in a single date also you may have 10 invoices. That means 10 transactions happen in single day even. So this is the invoice. Invoice is nothing but the bill. Okay, invoice is such a document which when given by the seller to the customer is an indication, or the customer now should understand that they have to make the payments to the seller. So invoice conveys that. Okay, invoice given by the seller to buyer is nothing but indication that you have to make the payment for goods whatever have been sold to you. So invoice number one, invoice number two, and then comes the customer's name. Let's say the customer's name is Alex, Tony, anything you can put. And then ledger, reference, like which page number, like let's say it is like AL like 2 Alex and TO1. Let's like put something. And then this is like dollar amount, whereby I put like $4,000. Okay, and $5,000. What does it mean? What does it mean? It means invoice number one has been served to Alex for what? It will be served, not served right now. This invoice number one, which has been prepared on the name of Alex, will be served to him. Now, why did I record his name in my books? Any clue? Because Alex has purchased goods from me, or I have sold goods to Alex worth how much? $4,000, for which Alex hasn't made the payment. He is supposed to make the payment in the future. So can I say this is a credit sale? Please tell me. Yes?
Yes, sir.
Yes, sir.
And what kind of sales you record in sales day book? All the credit sale transaction, right? Fine.
Yes.
Now let's go for the next one. And then you can total it. The total credit sales made by you is $9,000. Okay. That is what the sales day book shows. Like that you can do the totaling for the month end. Okay. To understand the monthly credit sales. And then what happens? This $9,000. Let's say this is like also Jan 1st. I'll just make things very simple for you. This is Jan 1st itself. On Jan 1st, we have sold goods to Alex of this much amount. On Jan 1st itself, we had a second transaction we sold goods to Tony of this much worth. Okay, it was also credit sale, understood fact. Now what will happen? The total of the Jan 1st sales day book is how much? $9,000, correct? Correct or wrong?
Yes, sir. Correct.
Now the total purchase, the total sales, so sales day book, the total sales for the day of, let's say, how much it is, $9,000 will be entered into the accounting ledgers in double entry format. Okay, understood? So whatever the sales for the day, that means on Jan 1st, total 9,000 worth of credit sales has been done. And this 9,000 worth of credit sales again will be recorded in ledgers in double entry format. And you already know what is ledger. Am I right? Please tell me.
Yes, sir.
Yeah. So make a note of this. So how will you make the entry? So let's say it will be a payables ledger. What is that? Payables ledger. So like a particular amount. What will you do? So Alex has purchased goods from us, correct? Receivables ledger, sorry. It was a credit sale. So receivables ledger is some ledger whereby we record all the credit sales transactions in double entry format. So the total credit sales we made is nothing but 9,000, correct? So what is the entry we have? Receivables to what? Sales, correct? Why receivables? Previously we had, let's say, okay, we had a transaction of Alex, $4,000. Now again we sold goods to Tony of 5,000. So my receivables is increasing or decreasing? Hello, my question, hello, are you following what I'm saying to you?
Yes,
I'm asking
sir.
a question to you. I sold goods to Alex of $4,000 on Jan 1st. Okay. Again, on the same day, I sold goods to Tony of 5,000. My receivables is, let's say, $0 right now. Now my receivables is how much? $9,000. Is it increasing my receivables or not? Please tell me.
It is, sir.
Yes, sir.
So increase in receivables is what? Asset. Okay. Increase in receivables is increase in asset. Increase in asset is what? Debit. Correct? It is debit or not?
Yes,
Yes,
sir.
sir.
Come on, I don't understand. So increase in receivables is debit. And this goods I have sold to them. So it is a revenue for me. So increase in revenue is what? Credit. So what is the entry here? It is increase in receivables. So I'll put that in debit to sales. How much? $9,000. Understood? Please tell me.
Yes, sir.
Yes, sir.
That is the entry. Please make a note. Then we'll go for purchase book. Increase in receivables, increase in asset. So it's happening because of sales.
Done, sir.
Yeah. Now let's go for the like purchase day book. Make a note of that. So date as usual, we'll take Jan 1st. Okay. So what is the difference between the sales book and purchase book? In sales book, we recorded all the credit sales. In purchase book, we'll record all the credit purchases. There we sold the goods to our customers on credit basis. Here we are purchasing goods from our suppliers on credit basis. Okay, here we are purchasing now. So there we would give the invoice to our customers. Here we will be served invoice by our suppliers. So make records of our invoices. Let's say invoice number 1, 2, and customer. It's actually supplier. Okay. Okay. So daily purchases made on credit terms. So purchase day book is like, yeah. So there are like sales day book. We sold goods to our customers, and purchase day book is nothing but to record the purchases which we made. Okay, that's what it is. Here you can find the mention. Credit purchases. Okay, so suppliers name. Fine. There it was customer. Here it is supplier. And there it was customer. Okay, here it is supplier. So supplier is, let's say, Harry, and let's say Ronnie. Anything you can write down. And then like ledger reference like HA2, RO2, whatever it is, like, and the dollar amount 4,000, 5,000. Okay, what does it mean? So this is nothing but credit purchases which we have made from our supplier. So credit purchases are recorded in the purchase day book. Same thing. And the total purchases what we made is $9,000. And the entry, we can post that in the ledger right now, correct? This total purchases of the day, which day? Jan 1st, can now posted or entered in the ledger in double entry format. How? So this is like previously we had receivables, now it is payables. So payables, ledger, particulars amount. So when you buy from suppliers on credit basis, there's an increase in expenditure because you bought. So purchase debit because it is increase in expense. Okay, debit. And then we have to make the payments to our suppliers. So from $0, now the payment has gone to $9,000. So it's a increase in liability. So credit. So to payables. Okay, credit. And then how will we record in the payables ledger? So it is like, you know, in payables we don't record payables. It's understood fact. So we record purchase. Okay. So increase in liability is what? Credit or debit? Credit. So we write purchases here because it shows increase in liability due to what? Due to purchases. Which purchases? Credit purchases. Please make a note of this. Like if you are comfortable, write buy. No worries. Once if you finish, please inform me. Once done, please inform me. Are you hearing my voice?
Sir, so that's the entry would be purchase account debit to payable, sir.
Yeah.
Okay. Yes, sir, done.
Okay. So here we are. So this is done. This is done. Okay, we will see the return box. There's a question here you can do as a homework. There's a question here you can do as a homework. Okay, then we'll go for sales returns book and purchase returns book. See, it's very simple. Sales returns book. See, when you sold goods to your customers. Okay, when you sold the goods to your customers, there can be some instance or there can be some situation whereby they can return goods to you. Okay, they can return goods to you, correct? So suppose you sold 10,000 rupees worth goods to Alex, and Alex found that the 10,000 worth goods, whatever you sent, out of that 2,000 worth of goods is damaged. So he will return that back to you, correct? So now you charge Alex how much? 10,000. Now Alex, what Alex would do is Alex will return the goods to you for $2,000, like of $2,000. What? Yes, of $2,000, correct? Now there is something which you should understand, something about credit note and debit note. So this you should understand here. The details are very clearly given about credit note and debit note. So what is a credit note? A document sent by a supplier to customer in respect of goods returned. So here is the supplier and here is the customer called Alex. So Alex has written goods to supplier. Now what supplier will do? Supplier will send what? Credit note to Alex. What supplier will do? He will send the credit note to Alex and Alex will return the goods. Return goods. Or I can say sales returns. Okay. So credit note, a document sent by a supplier to customer. So document sent by supplier to customer. Supplier, his supplier here is S and customer is Alex. In respect of goods returned. Why? Because Alex has returned goods to supplier. So a correction to an invoice previously sent out or overpayments made by customer. That means now supplier is telling to Alex that I quoted $10,000 to you. You returned 2,000 rupees worth goods to me. So you have, when you have returned goods of 2,000 rupees worth to me, that means my task is to give you back 2,000, which you have to get. That means you have made an overpayment of 2,000 to me. I will return the money back to you. Did you understand this? Please tell me.
Yes,
Yes.
sir.
Very simple, no? It's like this credit note shows the overpayment made by customer to supplier, which supplier has to return back. Point number 2, debit note. Debit note is a document sent by customer to supplier. See, when supplier gives credit note to Alex, Alex will give what? Debit note to supplier. Correct or wrong?
Correct, sir.
So you should understand, from supplier to customer, what goes? Credit note. That means it shows that Alex has made over supplier. Supplier will return back the money to Alex and Alex has to give the goods back to supplier. That is credit note. Now this credit note has gone from supplier to customer. Now when like the Alex has returned the goods, Alex will tell supplier that you have to return the money back to me for those goods. So he will give debit note. Okay. So debit note, a document sent by customer to supplier in respect of goods returned or an overpayment made. Formal request for supplier to issue a credit note. That means if Alex gives debit note, supplier gives credit note. These notes are kind of proofs that goods have been returned to supplier. Okay. And supplier has to return the money back. Okay. And since supplier has given the credit note to Alex, Alex is giving debit note to supplier. So both of them are exchanging notes and keeping records that that someone has to give money back and someone has to return the goods back. That's it. So now the sales day return book. So who has done the sales? The seller has done the sales to customer. So who is returning the goods to seller? The customer. So who is giving the credit note? The seller. To whom? To the customer. So sales returns book is the book of prime entry for credit notes raised. Okay. Whatever the credit note is raised by the seller to the customer, those things will be recorded in this. That means what you will be recording in sales returns book, all the sales, all the returned goods which you have got for the sales which you have made. Okay, so the credit note has been issued by seller to the buyer, and purchase return book is all about the debit note given by the customer to seller. Okay, for the goods returned. So in case of, let's say this is A, this is B. If A is the customer of B, that means B is the supplier, and A has written goods to B. So A will give debit note to him. Okay, for which the supplier will give credit note to A. Okay, so in purchase return book, it's all about debit notes, credit notes, debit notes. Sorry, this is a wrong statement. Yeah. So sales return book, the sales return book is the book of prime entry for credit notes raised. Who will give the credit notes? The seller to buyer. And who will give the debit note? The buyer to seller. So purchase return book is nothing but the seller, the buyer is giving the goods back to the seller. Okay, because he has purchased the goods, now he'll return back and he will give debit note in exchange for credit notes. Okay, that's all. So here you have the sales day return book. So J Spalding Boots has returned $200 worth of boots to whom? The seller. Okay. So so seller is maintaining this sales day return book, sales return day book, let's say. So this is sales day return book maintained by the seller, and he is writing the customers names from whom or the goods whatever the customer has sent to him or has returned back to him. Okay, so this is the amount of goods which is returned by J Spalding Boots, or the item whatever he has returned to the seller. Okay, or to the shopkeeper. That's what. And same case is with the purchase book as well. Okay, purchase return book as well. Now what books we have right now covered? We have covered 4 types of books: sales book, purchase book, sales returns book, purchase returns book. Now tomorrow we will cover up cash book and petty cash book. Okay, because now these two are the only books which we have to finish tomorrow, and also some theory in the start, in which 2 points we have already covered, that is credit note and debit note. So we have just some theory and cash books to be covered tomorrow. So tomorrow I can finish this chapter. Not much is left over. Cash book will take some 20 minutes lecture, petty cash book will take some 10 minutes lecture, and theory will take some 10 to 15 minutes lecture. Okay, so we can finish this tomorrow. Thank you.
Okay, sir.
Yeah.
Thank you, sir.
Thank you. Thank you.